Negative interest rates? Wait, doesn't that mean you get paid to borrow money? Yup, you got that right, and we might be seeing this in the US in the not so distant future. In the first week of May 2020, the financial markets started seeing the first signs of interest rates potentially going negative. Now, if this turns out to be true, the US would be joining Europe and Japan, which already have had negative interest rates for quite some time. Negative rates means that borrowers actually get paid to borrow money, and lenders have to pay to lend money. I know, it's kind of hard to wrap your head around, but if we do see negative rates, it's gonna have huge ripple effects throughout the economy, and I wanted you to be informed. So let's talk about it. In this video, I'm going to explain how negative interest rates work and what causes it. Then I'm going to talk about how negative interest rates will impact the economy, and more importantly, how it'll affect your wallet. And finally, I will share some tips on how we can save, invest, and manage our money in a world of negative interest rates. Get ready for some practical advice mixed in with a little Econ 101 with yours truly. But unlike some of the professors I had in college, I will try not to put you to sleep. All right, so hit that like button and let's begin. So let's start from the beginning. How do negative interest rates work and what causes it? The level of interest rates is determined by the central bank. So the primary role of a central bank is to control the country's money supply. In the US, we call the central bank the Federal Reserve, or the Fed. Since the US dollar and the US economy plays such a huge role in the global economy, the whole world gets impacted in some way or another whenever the Fed raises or lowers interest rates in the US. Think about it. When the Fed lowers interest rates, then money all of a sudden becomes cheaper, which means consumers, businesses can borrow money more easily. This has huge ripple effects throughout the world because businesses outside of the US can borrow money in dollars as well. So a rate cut in the US means countries like Brazil and Korea can get access to cheaper money. So it's not just limited to the US, because so much of the world's business happens in US dollars. A rate cut is generally good news for the economy because cheaper money encourages people to borrow, buy, and spend more, thereby stimulating the economy. In fact, aggressively cutting interest rates and keeping them close to zero was a huge factor in helping the US recover from the 2008 financial crisis and the recession that followed. However, low interest rates is not always a good thing, because if rates are too low for too long, that could cause inflation, which is when prices go up because there's too much money chasing a limited supply of goods and services. Also, if rates are too high, that is bad too, because then it gets harder for people and businesses to get funding, to borrow money to do things, and that slows down the economy. So there is sort of an equilibrium level, a sweet spot for interest rates that is not too high, not too low, just the level that doesn't create too much inflation, but also doesn't limit economic activity. So then, what happens when interest rates go negative? When the Fed controls interest rates, what they're actually doing is adjusting something called the Fed funds rate. All banks, whether it's your local neighborhood bank or the Chase, Wells Fargo's, and Bank of America's of the world, all these banks are required to keep a reserve of cash at the Federal Reserve. It's kind of like a security deposit that you leave with your landlord when you rent out an apartment. So every bank is required to keep sort of a security deposit of a certain percentage of cash in reserves at the Fed. And this is a regulatory requirement that basically safeguards the banking system. So as these banks park a bunch of money at the Fed in cash reserves, they can actually receive interest on this cash. If a bank has excess cash in reserves, it earns the Fed funds rate in interest. And if a bank is low on cash reserves, it can borrow money at the Fed funds rate in order to meet its reserve requirement. So that's what it means when the Fed cuts or raises rates. They're basically raising or lowering the Fed funds rate, which has ripple effects via the banks and what they can earn and what they have to pay on their cash reserves. So think about what this means. When the Fed funds rate is high, banks are encouraged to have a lot of cash reserves in surplus, because then they'll be able to get paid a lot of interest on this excess cash. Let me give it to you another way. The lower the Fed funds rate, the less incentive banks have to hoard cash at the Federal Reserve, and the more incentive they have to go and do something else with it. In other words, put that cash out in the world by giving it out as loans to customers and businesses. It's kind of like if you had a savings account and any excess cash reserves you keep in that savings account, if they're paying like 10% interest, you're probably gonna hoard that cash there because 10% is decent. Now, if they were paying 0% interest, instead of hoarding cash in a savings account at 0%, you'd probably want to go spend it, maybe lend it to friends for a little bit of interest, whatever. You'd probably want to go out and do stuff with it. So that's exactly how it works for the banks when the Fed funds rate is very low. Which means when interest rates at the Fed go negative, that means banks are even less incentivized to hoard cash at the Fed. Because not only will they not receive any interest, but they'll actually have to pay money on their excess reserves. That is how negative interest rates work. So imagine that you're a bank and you had to either pay 0.1% to keep your money at the Fed or lend that money out to a customer at 3%. Which would you rather do? So obviously you'd rather lend it out and make the 3%, right? So in an environment of negative interest rates, banks are hyper incentivized to lend out money. This expands the amount of credit available in the economy and is therefore good, generally good for the economy. Now, the Fed hasn't announced anything about negative interest rates anytime soon. However, according to the Federal Reserve Bank of Atlanta, the market is already pricing in the possibility of slightly negative rates starting in March of 2021. But of course, the market could be wrong and this might not actually happen. We'll just have to keep an eye out on any announcements from the Fed and see how things play out. If we do see negative interest rates in the US, that will definitely have an effect on the economy, both good and bad. To understand the potential good and bad impact, let's have a look at countries where they've been living with negative interest rates for quite some time. Specifically in Denmark, the Eurozone, and Japan. In 2012, Denmark's central bank cut interest rates to negative. And in fact, some Danish citizens are actually getting paid interest on their mortgage. In August of 2019, Jysk Bank, or Jysk Bank, don't know how to pronounce it, Jysk Bank started offering a 10-year mortgage at negative 0.5%. In effect, paying homebuyers 0.5% to borrow money to buy a home. If that's not bizarre, I don't know what is. Okay, yeah, that's pretty weird too. The thing is, in a world of negative interest rates, everything gets turned upside down. And I think this would encourage reckless borrowing because it's hard enough to stay out of debt. It just takes a lot of discipline and self-control already. But if all of a sudden you can get paid to borrow money, that could get a little crazy. So I'm not really sure how I feel about this whole negative interest rate thing. Debt is already a huge problem in our society, and I think that will just make it worse. Fast forward a few years to 2014, when the European Central Bank, or the ECB for short, launched negative rates in the EU. The ECB cut rates to minus 0.1% in order to prevent a recession. And according to ECB President Christine Lagarde, negative interest rates has helped create millions of new jobs and pretty much saved the economy, at least for now. Not only this, but negative rates in the EU caused the currency, or the euro, to weaken. As you can see, right when the ECB started cutting rates to below zero, the euro to USD exchange rate went from 1.4 to as low as 1.06, which is a huge move in a short amount of time. And the weaker euro actually ended up being good news for the EU because a weaker euro makes European stuff cheaper for Americans, and that would create more demand for European goods and services, which is good for the European economy. However, the dark side of the story is that Eurozone banks are having a really hard time staying profitable. Because of negative interest rates, Eurozone banks have had to pay over 25 billion euros to the ECB. That does not sound fun at all. According to the Financial Times, European bank stocks are down by almost a third since the ECB introduced negative rates in 2014. And the thing is, when interest rates go negative, it's not just the banks that are negatively affected. See what I did there? But pension funds also take a hit. Pension funds invest a lot of money in bonds so that they can earn interest on those bonds in order to take that interest and pay out their obligations to retirees. So if bonds are paying negative interest, that makes it kind of hard for pension funds to fund their obligations. What about over in Japan? In 2016, the Bank of Japan, or the BOJ, introduced negative rates of minus 0.1%. Now, Japan is a country that has a huge amount of government debt and practically non-existent economic growth. With almost $10 trillion in outstanding government debt, the obvious benefit of negative interest rates is that the cost of servicing that debt is really low. So negative interest rates benefits the government because they've got a lot of debt, but it is hard, as we saw in the EU, it's really hard on the banks and pension funds. But one place where Japan and the EU are different in their experiment with negative interest rates is that negative interest rates hasn't actually helped Japan get out of its economic slowdown. Because in the EU, it apparently successfully created millions of new jobs and saved them from a recession, but things actually aren't looking that good for Japan. Japan's GDP growth has been on the decline, meaning it's actually been shrinking, and combined with an aging and shrinking population, things are not looking good for Japan economically. So what can we learn from Denmark, the EU, and Japan when it comes to negative interest rates and its impact on the economy? Let's do a quick summary. Negative rates makes borrowing money really cheap, and in some cases, it's so cheap that even borrowers are getting paid to borrow money, like in Denmark. And this dynamic might encourage people and businesses to take on more debt, which isn't necessarily a good thing. Now, if the debt is used wisely and results in creating more income, then cheap debt is a good thing, as long as it's put to good use. But if people just get into more debt to buy things they don't need, then that is not going to end well. Also, just like we saw in the EU, negative rates can stimulate the economy, create jobs, and make European goods less expensive abroad by weakening the euro. All of these are net positives for the economy. However, the flip side is that negative rates is also putting a huge strain on banks and pension funds. And in the case of Japan, negative rates makes it easier for the government to service a huge debt load, which isn't necessarily a bad thing. But if the debt levels aren't even going down, then it's hard to imagine how they're ever going to dig themselves out of this hole. Given that we live in a really strange financial world where near zero and negative interest rates is now becoming the norm, what can we do about it? Surely this will change how we should save, invest, and manage our money. And although I don't have all the answers, I've done my best to think through this, and I have a couple of tips to share with you. First of all, do not borrow more money just because you can. If we do start seeing negative rates in the US and one day banks start offering to pay you to borrow, do not do it unless it's actually a smart move for your finances. Because just because debt is cheap doesn't mean you should get into more debt. It is dangerous to get lured by cheap money, so get ready to exercise extra discipline in a world of negative interest rates. If you're anything like me, you probably get a ton of those mailers from credit card companies offering you 0% balance transfers and all this kind of crazy stuff, and it could be tempting. And then what if credit card companies start offering you, like negative interest rates? I don't think that would happen, but you get my point, right? It's a lot harder to exercise discipline when taking on debt becomes so cheap, so I would definitely look out for that. Tip number 2, stay away from bank stocks, especially the ones with a big retail banking operation. Now, by no means am I an expert on the banking industry, so please take my advice with a grain of salt, but if you are a retail bank that has to pay customers to borrow money, it's gonna be hard to turn a profit. That's like a restaurant paying customers to eat their food. That does not sound like good business. In fact, this could even be the demise of the banking industry. I think a lot about kind of big picture trends and what the future is going to look like and how it's going to be different from life as we know it. And I do think the banking industry is one of those industries that is just like prone to get disrupted. So not saying it's going to happen overnight, but the rise of fintech companies like SoFi, Lending Club, and Venmo are basically starting to replace banks and making them more and more obsolete because you can do a lot of these financial transactions, borrowing, lending, without banks in the picture as a middleman. So if you understand banking and you understand bank stocks, by all means, go ahead and invest in them, but I would definitely stay away from them until it's a little more clear what the negative rates picture in the US is going to look like. My next tip is to invest wisely. The primary driver of stock prices and real estate prices these days has been interest rates. Unfortunately, asset prices have become less and less linked to the actual underlying earnings of those assets as much as just where interest rates are going and how much money is being pumped into the economy by central banks. When interest rates are really low, that increases the amount of money circulating in the system, which pushes asset prices up because there's a lot of money chasing a finite pool of investments. Think about it. If banks are offering to pay you to borrow money, how many more people do you think are going to run out and start buying property and even stocks with borrowed money? So that would obviously push asset prices up all across the board. So if we see negative rates in the US, that actually could make stock prices and real estate prices go even higher. And if that does happen, of course, that's not going to go on forever necessarily, because a lot of people think this dynamic is creating an asset bubble. I don't know if that's true or not. I mean, they're probably right and we'll only really know in hindsight, but just in case, make sure to invest cautiously by diversifying globally and dollar cost averaging. I talk more about dollar cost averaging in this video right here if you are interested in a deeper dive into this subject. What makes it tricky is the alternatives for what to do with your money, whether it's put it in a bank account or invest it. These alternatives are basically becoming less and less attractive, and it's sort of like we have to just pick between the lesser of two evils. Because if you keep cash at the bank and interest rates are negative, you might actually have to pay money to keep your cash there, right? If you're keeping money at a bank, normally they would pay you interest, but if in a world of negative interest rates, you are gonna have to pay the bank interest. So it's either that or invest it in stocks, bonds, other assets. Honestly, I don't know what the answer is, but I know that not investing isn't an option, but also just keeping your cash in a safe or under the mattress isn't an option either. So I would say keep investing, just do it cautiously and exercise good risk management principles such as global diversification and dollar cost averaging. Okay, what else? My next tip is, now if banks become dysfunctional due to negative interest rates, as I mentioned earlier, they might even start charging customers to keep their deposits with them. Crazy, right? So negative rates might mean you'd have to pay interest to Bank of America or Chase, wherever you keep your stuff, in order to keep your money with them. And if that becomes the case, I'm probably not going to want to keep my money in a bank account. Better off keeping cash under my mattress even, or even storing it in something like gold or Bitcoin. I'm not saying I'm going to do this yet because rates in the US have not gone negative yet. However, it is something to think about and consider for the future. Because in addition to investments, where are you going to put all of your extra cash if you have to actually pay money to keep it somewhere? I'd rather keep my extra cash stored in something like gold and Bitcoin, or something where you don't have to pay a bank to keep your money there. All right, and since I mentioned gold and Bitcoin, I actually have a lot to say on this subject. So I'll be releasing a video about it next week. I'm going to talk about money printing, fiat currencies, central banks, gold, how to protect yourself from runaway inflation, and all that good stuff. So if you haven't done this already, make sure to subscribe to my channel and hit the notification bell so that you won't miss out on that video. As always, thank you so much for watching. I post new videos every Wednesday, so I'll see you next week, same time, same place. Until then, take good care of yourself and take care of your loved ones. Stay safe and be well. Bye.